Hello, everyone. Welcome to OpenViews 23. I'm Leandro Piano. I'm VP of Finance at Belvo. I'm excited to introduce you to the incredible speakers that are joining us today to discuss about the fintech trends and opportunities in 2023. So first, I would love to introduce to Phil Teixeira, which is the founder and CEO at Shoppers. His own fund launched in January this year. Before founding Shoppers, he was the first employee at Redo Sofia, where he developed the fintech focus there. We also have with us Adams Conrad, that is principal at QED Investors, focused on seed stage fintech investments. Before joining QED, Adams worked for Kovo, which was acquired by Plaid. And the last to close this group of speakers, we have Apurva Goyal, Vice President and Insart Partners, investing in high growth fintech, internet, and software companies from Series A to IPO stage. Thanks everyone for joining us to this session. It really pleasure having you here today. So to get started, let's take a look to the current context to the fintech fund environment. In 2022, the sector experienced a slower pace of investments globally in relation to 2021. We have a significant drop in Latin America companies. We recorded the record in 2021, which dropped at plus than 70% on 2022. And a general movement of the tech companies towards more financially sustainable operations, looking for more possibilities to fund their business. That includes not only cash generation, but also new vehicles to access third-party capital. So to start, I'd like to ask Phil, after a year that may be described as challenging for this ecosystem, what are your perspectives about funding, growing or slowing in 2023? And what have you observed so far this year? Should we expect better times coming, or challenges are still the reality for everyone?
Hey, Leandro, thanks for having me. So look, I think, first of all, I'll just put things into context. Sort of like, as you say, 21 was a record year, but sort of like, and 22 and 23 seem like really painful, but it's still sort of like much bigger than where the ecosystem was sort of like 5 or 10 years ago. And so you obviously sort of like had a LATAM being a huge beneficiary of the last cycle. Capital poured in really quickly in late 21, early 22, and then everything changed really fast, right? With the global challenges, most international investors, and I think you've got plenty of them in the call, have focused a little bit more on their home markets, and leaving emerging markets even more exposed. And then 2022 was a year where companies had to react fast and take painful medicine, I would say. And I think we're still in this hangover phase. And we've seen very little activity so far in 2023. And in my view, that might still be the case for the majority of 2023, and mostly for 3 reasons. First, you've got a little bit of an adverse selection problem at the moment. Most of the good companies or great companies have either extended their runway through a combo of reducing costs and or bridging sort of like rounds from their existing investors. Of course, this is a generalization, and sort of like I think some great companies will be raising this year. But secondly, and this is a bit more related to investors themselves, most investors, especially from, I would say, Series A or B onwards, don't really know how to price risk at the moment. And a lot of them are afraid to overpay now for the markets to, let's say, settle on a much lower revenue multiple in 6 to 12 months from today. And so they could look quite stupid to their LPs and to the rest of the market. And so I think that's actually happening. And thirdly, and this is again sort of like fund related, but not for everyone, I would say that a lot of funds, especially most recent ones or ones that have raised and deployed a lot of capital at the top of the cycle, they're themselves not sure when they can fundraise again, how much and when. And so they're extending their runways by deploying slowly, just like startups are doing at the moment. And so for those 3 reasons, I think, and there's more, but I do think that 2023 is still going to be sort of like a difficult year. The good news is that this can last forever, right? There's plenty of venture capital sitting on the sidelines. Everyone talks about that. Sort of like there's a bunch of dry powder, VCs getting a little bit itchy. In LATAM specifically, you've got sort of like potentially a big gap left by SoftBank. But the good news for the ecosystem is that in the last 5-6 years, you've seen the rise of some very, very large local funds. I'm thinking Kazakh and Monash's, but there's plenty of others. These guys have raised like 3 to 5 times more capital than they used to like 5-6 years ago. And so they can now bridge a little bit more of the gap, sort of like from seed to late stage, which couldn't really happen 5-6 years ago. So no one really knows when the markets will reopen and at what valuation multiples they do. But my guess is, and sort of like it's as good as any other guess, but sort of like this should happen gradually, sort of like sometime in late Q3, beginning of Q4, but it's only in 2024 that things will accelerate a little bit. Of course, not to the levels of 2021, in my view, and of course not to the same valuations. But that's also going to be when you see a lot of companies default, right? Because companies will get to the end of their runways and the good and great ones will be able to raise and some others won't. And so long story short, I'm quite optimistic about the future if you think about like medium to long term. But in my view, 2023 is still going to be a relatively tough year, if that makes sense.
No, perfect. And that really makes sense. And I think that when we were back on 2021, we were expecting that 2022 probably would be a year that in the end would come with better news and probably 2023 starting better. But on the other hand, as you said, a lot of companies initiated a lot of changes into their internal dynamics to make sure that they could extend the more they could, which make, again, challenging 2023 again in the overall market. So Adams, for you, considering a lot on what Phil brought about the markets, but now looking for the companies, for the fintechs, what are the main challenges that those companies will find during this year to raise capital, and how could they overcome them?
Great question, and thank you for having me here. Phil, I think some of your points there are spot on, and to build on top of them, really we saw the high watermark, the tide roared in, and it is now rushed or rushing out, depending on who you ask. I think one of the biggest questions investors and startups should be asking themselves is, what does that bottom out moment look like? No one wants to catch a falling knife, but everyone wants to be building and investing in to a rising tide environment as well. The challenges piece here is really important to internalize and think about. Ultimately, building a business is about turning over cards. It's about learning, testing hypotheses, and then stacking those hypotheses on top of one another. And as the tide has rushed out of the ecosystem, or at least in terms of capital, has rushed out of the ecosystem, orienting and focusing on quantitative metrics has become even more important. So this means focusing on unit economics, having an eye towards profitability or a path to achieving profitability, and the hypotheses that you are running and testing at any given moment must be more capital constrained. They must be much more capital efficient than they perhaps were in this environment. And then the final piece I'll touch on here is the impact that rising rates and inflation has had on businesses. It's important to internalize this and really understand how this has impacted your business. Many businesses have seen benefits from this change. So it's not all negative. And similar to, I think, some of the challenges we've seen, it's not all just a binary good or bad scenario here. There are many businesses that are primed to do well and even better than they were a year and 2 years ago. I think when we look at the outflow of capital, that tide I'm mentioning pulling out of the ecosystem, the reason we're still so excited about fintech across LATAM is we're not seeing that happen with consumer behavior. People trust fintech applications. They're still adopting fintech applications every single day. Businesses are still using fintech more today than they were yesterday, and we're confident they will use it even more tomorrow. That core premise is what matters far more than the periodic ebbs and flows of capital as it comes in and out of the environment. As long as real problems are being solved and real financial problems are being solved with technology, there are startups to be built and there are fintech startups to be built. So what I'd say in looking at it and internalizing these challenges is, as long as you're continuing to focus on your unit economics, continuing to focus on solving real problems that customers and your clients are facing, and do so with an eye towards profitability and testing those hypotheses in a capital efficient way, everything is going to be fine. Businesses will survive this environment and be much better for it.
Great. And this is sorry,
can I add one point?
Absolutely.
Saying, I think Adam really hit upon really good points. I think one of the other things that I feel like a lot of founders have to start evaluating these market is, there was a bunch of easy money available. So a lot of them were building what was essentially features as companies, and they were not essentially platforms. So I think the next 2 years will also be a great place for consolidation. A lot of these features will find its place into good platforms. And so, there are companies which can be great features and will only be able to reach at a certain point in scale. So it's also a good time for founders to evaluate and test out product market fit, because, they've been sitting on 30, 40, $50 million of cash without really establishing product market fit. And I think for companies where founders are honest with themselves that, hey, I don't think I'm there yet on a PMF, it's a good time for you to consolidate and evaluate being part of a larger platform, and kind of contribute to a larger story, because that platform, is better suited to succeed in these capital constrained markets than as a standalone feature company. So I think that's the other aspect of it, which I think a lot of founders have to start thinking about, in where they stand in the broader aspects of how large they can be and whether they're better suited as a standalone asset versus being a part of a larger platform.
And just if I completely agree with that. So if I could just add one more point, which I think is important here, is that, at least in my view, there's absolutely nothing wrong with a down round. And I think a lot of founders just obsessing with the idea, well, I raised at 50 or 100, so now I need at least that valuation, if not more. If you were the only company in which that was happening, probably that would be harder to justify and explain, etc. But the reality is that that's happening a lot. It's very common these days, and it is about how you motivate the team, how you tell it to the team, and how you set up the long-term incentivization plan. And so you should regard your previous higher valuation just as less dilution in the past, but effectively it shouldn't condition your expectations for the valuation now. And of course, now it's a lot more common, but even today, we're still seeing some founders are obsessed about their previous valuation. And I just think that's that's wrong, and you got to let that go. And the market will decide what's the right valuation, and you just have to deal with it.
Oh, perfect. That's because if you look at building a sustainable and long-term business, in the end, valuation A versus B versus C is just one part of the journey. So it's a path that you need to follow to make sure that also connects on everything that you mentioned on product market fit, sustainable and healthy financial profile. It's a lot more on building a company forever. So I want to have a business that will remain always operating in the market that I decided to operate and delivering the services to the customers that I expected. That in the end, we are coming back with some fundamentals since the beginning of building business that I wouldn't say that we forgot, but at least we were not prioritizing too much for a moment on the opportunity of capital and development that we could see in the industry. But also connecting to these, we need to consider that a lot of trends, they're still really attracting. And all of the investors really look for that and approve for, on your perspective, what should be considered as those trends that even in a different market environment, they are really attractive, and founders shouldn't lose these from their perspective, assuming that just cash generation that we are really hearing a lot now is the right one.
Yeah, no, and I think it's a great question. And I think there are few trends that we are seeing that continue to be very secular, whether it's a down market or up market. There are a lot of consumers across, whether if you think of them as fintechs, legacy financial organizations, or even, larger set of SMBs or mid-market companies that kind of want those solutions in the back of the office, suite of tools that they have. that they would continue to use. And I think three things that we continue to see, three trends that we continue to see have become, more and more essential as time passes by. One of them is the whole idea around increasing need of regulatory and compliance tools. With increasing times, there is an increased focus on ensuring these companies are meeting a certain standard of regulatory and compliance needs across regions, and across stages of companies. And so a lot of the tools that are able to kind of service a lot of these needs would only increase in demand, and this market will expand really fast. So I think that's one theme that we feel like is secular, and you will continue to see businesses in these thematics continue to do really well. The second thematic that we feel like is emerging fast with how fast AI and machine learning technologies have been moving. There is one of these seminal moments where you have a chance to redefine customer experience for a lot of how financial services are dealing with customers. There is a lot of change on how cost re-engineering will happen, because you'll be able to write a much more effective code tech stack, be able to underwrite much more effectively, target a customer much more effectively compared to what you were doing in the past. So I feel like there is this whole new emerging class of AI ML solutions that will come in the next few years that will redefine what fintech, is for the financial services organizations, or also how fast some of these financial services organizations will adopt these new emerging technologies to be able to better cater to a lot of these customers. And I think the third theme that we feel, which is a lot more focused on your SMB mid-market kind of clients, is there is an increasing focus on FinOps, because a lot of these companies are moving into cloud deployments. And so there is a better need of an advanced cybersecurity solutions that are focused on these smaller banks, smaller fintechs, and all of that. But also as they move to cloud deployment, financial management of your cloud expenses and a bunch of SaaS tools that you have is becoming another theme that becomes more and more increasingly important in these markets. So I would say these are three themes that I would call out as things that are particularly exciting for us. But I'm sure Phil and Adam would have interesting themes to add to that as well.
Yeah, maybe just the one thing I would say, sort of like on your first point, sort of like I couldn't agree more. Although sort of like it's obviously a very sort of like fragmented market, sort of like it's a difficult one to scale. But like I think that sort of like this this regulatory arbitrage that led fintechs to actually sort of like grow so quickly, so fast, especially on the consumer side over the last few years, is coming to an end. Sort of like, and I think in Europe that happened maybe a little bit earlier than in the US, and like we had like Wirecard and then Brazil and a few different things that put the regulators on high alert for some of these companies, and then now we're actually seeing that elsewhere. And so I couldn't agree with that more. I'm pretty excited about those teams. I'm excited a couple other things, sort of like including on building sort of like operating systems for certain verticals and industries. But I know we don't have that much time, so I'll keep it short.
But Phil, bring a zoom to Latin. How do we assess these current landscape of investments in Latin America, financial innovation? How do you see the region really assessing this moment now?
Yeah, look, we spoke a little bit about the investment landscape globally before, sort of like on the first two questions. And I think as we mentioned, sort of like I think there's an excitement that sort of like you are sort of like building at the beginning of a new cycle. Maybe as Adam was saying, sort of like you might still be sort of like with the falling knives phase, but at some point sort of like that's going to change. And in terms of innovation for LATAM, to me at least, it feels like it's a very exciting time. You've got, especially in Brazil, I want to say, and which is the market that I know the best. So you should chime in, sort of like if I say anything wrong here. But it's been very much at the forefront of financial regulation matters globally. Actually, I'm thinking BICS, for example, sort of like which continues to grow insanely fast. The latest stats I've seen there, sort of like it's over 100 million transactions a day. It's like over 90% or 93% acceptance rate on e-commerce transactions. This is absolutely game changing, not just for Brazil and the region, but even in a lot of other countries. And so I think other countries are starting to take notice. Another thing that I would point out too, so like would be like the digital or the crypto infrastructure and digital assets lawmaking, where sort of like Brazil, and I'm thinking specifically sort of like the central bank and the CMV, sort of like the Securities and Exchange Commission in Brazil, have been sort of like very proactive in terms of regulation. And so from sort of like a non-native, sort of like I'm not for the region, but I'm investing in the region, sort of like, to me, that feels like quite exciting and forward thinking. And so I think there'll continue to be sort of like lots of exciting things to build in fintech. Obviously, there's still so much bureaucracy and challenges, but this progressive thinking, in my mind, will continue to foster innovation. And LATAM is a place of still much opportunity, and I think that's why we're all on this call and all excited about it. There's lots to build. And I want to say as well an important thing. So like there's a great second generation of founders sort of like coming to build over the last couple of years and the next few years with much deeper down ventures, which makes me excited about sort of like this innovation landscape. So as long as you don't expect sort of like crazy valuations in rounds, I'm actually quite optimistic about the future of the region.
And we need to consider that LATAM in the end, if I would assume the first venture that I joined in fintech environment in Latin America is just 8 years ago. So it's really new, everything that it's come. So the opportunity that we have to explore in the region is still massive. And as you said, we could see Brazil as the first mover in terms of regulation and how we can help the ecosystem to develop better and faster. That for sure the other countries are looking for this and are getting as a benchmark to get also benefit for their countries. And say about these as well, another topic, as you mentioned, crypto, PIX, we also should consider central bank as a benchmark in terms of open finance in Latin America, everything that they are moving in terms of regulation. And Adam's getting a benefit on your previous experience as well. How do you see this open finance industry? What should you expect for this industry 5 years down the road? How excited would you be with open finance in the region, specifically here?
Yeah, it's been a really interesting journey over the past 5 years. And then when we play the tape out the next 5, there's a lot yet to come. Taking a bit of a step back, I view infrastructure broadly as tools that enable folks, businesses, and innovators to build and sell new things that they could not before. So kind of starting with that simple primitive, when we look at open finance, the really core pieces that folks started building, first and foremost, were insights. When I started with Quovo, we spent a good chunk of time figuring out how do we unlock the insights for that consumer, their independent cash flows, or their family's lending portfolio or investing portfolio. The exciting part that we're starting to see a shift in across the industry is really looking towards action, enabling folks to take those insights and then do something with it. And this really applies to the whole spectrum of financial services: taxing, investing, borrowing, movement of money. All of those things are changing, and open finance is playing a pivotal role in enabling that. Just as open finance was critical in enabling those insights, open finance will be critical in enabling that action. The piece that I'll kind of build on here that Phil, you touched on, I think perfectly, is how impressive account-to-account real-time payments are, and the impact that will have across the globe should not be underestimated. And similarly to the insights and action that open finance was powering in an investing construct, it will also play a critical role in account-to-account payments, both in a P2P construct, but in every other flow and movement of money that I think we see both within a single country and also globally.
Amazing. Apurva, if I could get your contribution also on account to account that Adam's brought to the discussion. I know a lot of extensive studies that you've been done on account to account. Could you give us more perspective on the trends and also on how account to account has been powerful in other regions like US and Europe, and what should we expect coming in the next years in the region here?
Yeah, no, happy to. I think in general, I think we believe that even within US and Europe, account-to-account payments are still like in their early stages of the journey, and this can really be massive as it grows. I think one of the interesting insights as we've studied US, Europe, quite closely around the A2A aspects of it is as we look about new geographies, what are the key ingredients that kind of help us believe in which countries would you find A2A payments just really blow up, and where you are not sure that this might blow up or not. And the few common themes that we around came up about was one, I think purely from a market readiness perspective, any country that has a strong instant payment rail system has seen A2A really kind of pick up quite substantially compared to countries where there hasn't been an existence of an instant rail payment system. So that's been one. I think second, I think the presence of open banking regulations and a proper API harmonization kind of done across a bunch of these different setups have been critical to wider adoption of A2A. So in markets where these haven't been in existence, we haven't seen really A2A pick up quite a bit. I think one of the other things that we've kind of seen, which is very interesting, is countries that typically have low reliance on card payments have seen more A2A adoption compared to countries that have high reliance on card payments there. And lastly, there are countries where there have been existing banking consortiums which have been partaking in the adoption of A2A payments. We've kind of seen the consumer adoption way faster in those countries compared to, companies where, there are fintechs who are trying to kind of drive those adoption. It's an uphill battle. And, there is friction to consumer adoption in a lot of these use cases. And I think these four setups have kind of defined as we think about different countries and setups, and in which setups and regions do we feel that account to account payments are better premised to come and win as a setup. And in that layer, what company would therefore take a larger share of this. And there are regions where we feel like, because one or many of these factors don't exist, we wouldn't feel, or we wouldn't be as bullish on A2A factors there. So I would say those are some of the early learnings as you kind of track US and European A2A markets, and kind of apply that to other regions and the lenses on how you think about A2A, if that's helpful.
Great, Apurva. When we jump to amazing conversations, the time flies, and unfortunately, we are moving to our closing. So I would ask for each of you your last 30-second considerations on this topic. So please, first Phil, and so Adams and Apurva, your 30 final seconds.
Happy to. So look, I think I would say something similar to what Adam said before, which is sort of like focus on building real business models and building on what Apurva also said on like just not building features. So real unit economics, acceptable capital needs, so something that you don't need sort of like that much capital early on, some modes, and then just execute on it. Sort of like, even if it doesn't look like it right now, it's a bright future out there, sort of like, and you've got the opportunity to shape the future. And so I just focus on that execution.
Amazing.
I'd agree. This market will reward those that execute and focus. The core building blocks are coming together quite nicely. Even if the capital side of things is less than exciting, the core infrastructure that it is being built and rolled out across all of LATAM and globally presents a tremendous opportunity for fintech and for entrepreneurs to build real solutions that solve real problems.
Yeah, and I think I cannot agree more with Phil and Adam. And I feel like a lot of people have painted not so rosy picture for fintech, just given how the capital markets is. But I think I continue to be a strong believer that there will be multi-billion-dollar cap gains and companies that will emerge out of these categories, because there are real problems to solve. Those are large problems, and we are in very early stages of those problems being solved. Digitization, adoption of better payments, better consumer services are all unmet needs across regions that you will see. And as long as you're focusing on these real problems, and are hunkered down, not thinking about capital, but kind of just building companies that are product market fit in large categories, and are actually solving for customer needs, in no time things will blow up. I think the only other caution that a lot of times when founders come up with tech lenses is not engaging with regulators as much in these regional setups. Is I think the thing that we should be cautionary with increasing regulatory glare on the whole fintech ecosystem. It becomes very important that founders are playing a contributory role in engaging with the local regulators and being compliant in laws and helping evolve the innovation landscape in those regions, and that will go a long way in kind of ensuring a durable and a sustainable fintech ecosystem.
Amazing. Excellent, guys. Thanks for all the knowledge shared with us today. Really powerful hearing from such relevant people on this investment and fintech industry. Also, thanks for everyone who joined us to the session today. We hope you had enjoyed the session like I did. So see you soon in the next sessions, and bye. Thank you.
Thank you.
Thanks for having me.